Hey everybody, Courtney Smith here for January 28th. Our Wall Street winners. Big changes this last week, really quite incredible. Nothing, of course, is more incredible than this disclaimer. Let's get right into it, though. First of all, the S&P, we had the little double shuffle this last week where we made a new high on the move, then we retraced, and then we got back up towards the old highs. The main picture on this story is the purple predictor, that purple line there, accelerating higher. That's bullish. So the chart picture here is not particularly different than last week, but some of the internal dynamics have gotten far more bullish. So that's a fantastic thing. For example, take a look in the upper right-hand corner. This is the Dow. The green line is buying pressure, and you can see it hooked up sharply. At the same time, we saw the selling pressure, the red line, it went down. That's a very bullish situation. And as you can see in the chart below, we actually did make higher highs on this particular move. So that's a significant change in the underlying situation. The Nasdaq did the double shuffle too, but look at that purple predictor. It's skyrocketing, showing that the smart money is coming in and buying hand over fist to buy Nasdaq type stocks. We've been highlighting how small cap companies, value companies tend to do very, very well in January. We're certainly seeing that. We're also, for fully paid up members, technology stocks are now in a bull market. That's a change, and that shows that the market's getting more bullish. Our seasonality remains neutral, though. I think we really have to get up. At this point, I'd have to say we have to get up to about 158 before I'm going to turn that switch back on to bullish. We should be in a bull market. Should be seasonally strong until July. Now, the yield curve, which had been a major problem, notice that the market is basically just following the shape of the yield curve right now, because the yield curve normally is not that important, but became extremely important in November and even now here into January. So we've backed off that danger zone. We're not in the danger zone anymore, but we're awfully close. So we have to continue to focus on this indicator. Asset allocation rebounded in January, showing that money is coming into the stock market. You see, you can't have a bull market without money coming into the market. So what's happening is they're selling bonds, they're getting out of cash, they're coming into the stock market again, and that's very bullish. Our RISKDICATOR, Pop-A-Rama, look at that thing. It popped up a lot, telling us that market participants are saying, you know what, we don't want to hunker down anymore. I don't know if there's such a thing as hunker up, but whatever the opposite of hunker down is, they don't want that anymore. They want to find risky stocks like technology stocks. They don't want the less risky stocks like consumer staples and utilities, and that's what this indicator is showing. You can't have a bull market without people wanting to take risk. Global shares basically following the U.S. up, but generally speaking, less bullish. Now, I have a big change in the bond market. I'll show you why in a second, but I'm getting out of my long bond positions. I don't want to be long bonds anymore. Let's take a look at our key indicators. You can see that bond yields popped up a little teeny bit, or I should say note yields popped up a little bit. That's the green line. Now, if you look at the blue line, that's 10-year treasuries in Germany. They hooked up a little bit. That's really the most bullish factor for bonds. But the other two factors, which is the CRB, which is the actual chart itself, it's really rallied sharply recently. And you can see the gold line, that's the price of gold. It's rallied a lot. So we've now got, let's call it, two of our factors definitely saying higher interest rates. But the blue line is the most important one, and it's still neutral. But here's the way I look at it. I want everything working in my favor. I don't have everything working in my favor anymore, so time to get out of bonds. We'll take our profits. The dollar looked good in the early part of the week and then slam-a-rama on Friday. Look at that sharp down move. And of course, if the price of the dollar is going down, then that means the gold price is going up. Now, I really got out of my gold positions a week ago. Unfortunately, a week too early. We didn't get this resumption. So I'm going to wait a week. I'm going to pause. I'm going to consider what's going on. I'm going to ponder this. But obviously, Friday's price action was very, very bullish and suggests that maybe this bull market is back in force instead of the dribbler that we had gotten into. So if the dollar's going to plunge the way it is, then gold's got to be going up. Our factors, though, never really changed, okay? Take a look up at the top panel. That's the euro. Really not a big deal. The middle panel, a little bit bullish. That's the CRB index. The bottom panel didn't really change at all. So that's why I want to wait a week. Let's just see how these indicators develop before we get back in. The price of oil, I'm getting more and more bullish. We got back up to the previous consolidation zone, but I think that supply is going to tighten. At the same time, over the short run, I think demand is going to improve. Sentiment's going to improve, but the key factor is the Saudis cutting production. Bitcoin, really have nothing to add to what I said yesterday. Purple predictor is slowly grinding higher, which suggests that maybe this bear move is over. I've been suggesting being on the short side here, but over the last really month, it's gone nowhere. So in a market like that, usually the best thing is to just get out. You're not really making any money, not really losing any money. But if you can use the capital someplace else, get out of Bitcoin. On the other hand, if you're already short and you've got excess capital, you might as well keep it. But your stop loss has got to be getting tighter and tighter and tighter. And I think that really putting the stop loss in at around that 41.14 area is probably the more conservative approach. I put a bigger chart than usual here because look at the volume. The volume had been very, very active, but now it's really become inactive. It's become a doldrums. Now, doldrums usually occur at bottoms. They definitely don't occur at tops. So doldrums can extend for weeks and months, okay? So that's one reason why I'm thinking I just don't really want to be in Bitcoin, because I think if we are going into a doldrums, and we've been there now for a couple of weeks, then we could see the price do absolutely nothing for quite some time. All right, everybody, thanks very much. Our new edition is coming out this week. It's all done. You should probably start getting notices on Monday or Tuesday. So it's all done. It's all set up. I think you're going to really enjoy this one. It's, I think, twice as big as the previous edition with a lot more in it. You must get it. But just wait for your email. You should get it if you're on our list. And, of course, I highly recommend Stock Butler for some tremendous ideas. All right, that's it for me. Freebies, love having you here. Fully paid up members, hang on 1 second.